Hello and welcome to another episode of Monday Markets. As always, we're brought to you by Woo. Links available in the description below. We'll have some fun news to share soon as the designated market maker program is in full swing, as well as other developments. But for the time being, be sure to check it out if it's applicable to you from a non-restricted jurisdiction. And also with any exchange that you're using, make sure you only keep the minimum necessary amount of funds for your trading. That's the whole point of trading with leverage. So with that fun intro out of the way, as always, leave a like if you enjoy these, and thank you for your comments on Casual Friday. Even in these market conditions, it's still fun to speak and interact with you and make content, and thank you for sticking by us, even though as a majors, BTC, ETH, high cap altcoins oriented show, we don't make it easy, and the market doesn't make it easy for us in these conditions. Nonetheless, let's have a chat. So I'm not going to waste your time with the monthly time frame necessarily. We're only a week in. For the time being, we've spiked below previous month's low, so we'll be curious to see whether we get acceptance or rejection below there. I really think if you're going to be using the monthly time frame, which should be done with some reservation, given it's just not great in this area, if we're going to have a deeper push down, as mentioned, the sort of 26 level as some form of monthly range low, kind of the low made before the ETF bounce, makes sense, but we've kind of reached the first inflection point to see if any buyers want to step in at previous month's low. But again, with 24 days left, I'm not going to read into this particularly closely. The weekly time frame is curious, so it has been just simply drifting down and making lower highs and lower lows, or frankly just moving diagonally like this, drifting lower amidst low volatility. If you wanted to start making weird fractal-based bullish arguments, you would start drawing stuff like this, essentially weekly drift, upside break, weekly drift, upside break. It's not the best argument in the world, but I can see why some people generally correlate low volatility with bullish price action. Historically, that's been the case. If you want to see why this time may be different, I think Don made that case somewhat compellingly on Casual Friday, so worth scrolling back to check it out. But the weekly chart really isn't saying much. It's just sort of drifting lower for the time being and no impulse yet. In terms of weekly levels, I still think the levels are more or less the same. As far as the earliest inflection point, for me, we're coming up to it at 29.2, 29.3 on a weekly closing basis. This was sort of the lower high shelf, and we bounced there initially. We closed below last week, and so if this level is going to be important, this may be, this is by definition a retest week. And then the weekly close will provide some color as to how these subsequent weeks will go ahead. I think you can make a bullish argument if the weekly closes above it and doesn't look terrible. At that point, you'll essentially have had a swing low form of sorts, low, lower low, higher low, and a reclaim of a weekly level. So that could be reasonable to squeeze up to something very conservative, like the pre-breakdown point at 30.1 maybe, if not the range high at 30.3. That's something, at least it would be some semblance of weekly structure. So that's kind of probably the earliest bullish signal you're going to get on the weekly time frame as far as reclaims go. But in itself at the moment, there really isn't much to say about it. It's at the underside of the level for now, and you have to essentially wait to find out if it's going to be support or resistance. It's currently resistance because we closed below in our retesting, and the weekly close can mitigate that if it closes above. So at resistance on the weekly, but kind of it's a level I'd much rather long if it reclaims above it on the weekly than short into necessarily. But that's not a particularly strongly held view. If we zoom out slightly and look at where else weekly interest lies, I still think this pre-breakdown range is quite reasonable. At 26.7 as the pre-breakdown range low and 28-ish as the pre-breakdown range high. That to me is interesting, and you can always sort of splice it up and derive a mid-range from those levels if you want to get more granular on the lower timeframes. But generally speaking, that's the next reasonable area as far as the weekly goes if the market continues lower. Everything else would start to look pretty bad, as we've discussed ad nauseam, given the market hasn't moved. If the market's just weak through, if it starts to penetrate the ETF candle, I think that's going to lead to a decent chunk of panic selling. That could make for a good opportunity as those news sellers puke and do so aggressively and trade aggressively at bad prices. But it's one of those wait and see scenarios. And, if the aggression is sufficient, you expect bigger dislocation, and that means you're going wick fishing in that area as opposed to buying the support resistance structure outright. So it's one of those wait and see ones, but technically the structure is there. The daily time frame is one of those time frames where you might be inclined to call it chop, but it's also just been drifting lower. I mean, the anatomy of this thing has been failed breakout, range breakdown, and then resistance retest. So that's not great. If you're looking for signs of reasons for optimism on the daily time frame, I think your argument has to be essentially premised on the weekly time frame discussion, which is you have a low and you have a 3 spikes essentially that turn into a swing low, and if the weekly starts to look good, you could get a bounce. Targets for any type of bounce would have to be really humble, just because this whole area is super congested up until 30k. But generally speaking, at the moment, the trading range appears to be that this weekly wick is being defended down at 28.8, and the important resistance level is still at the pre-breakdown cluster at 29.8, 29.9. That's the range we're in, and if you wanted to get a midpoint of sorts in there, you get it at around 29.4 to 29.3. I mean, bigger picture, I am going through the motions of looking at levels and talking about market structure and whatever else, but it's largely performative. I mean, the market is absolutely tiresome, right? Volatility just keeps drifting lower. It's not at particularly interesting levels. 30k, 30 plus is interesting. Lower levels of 27 and even lower are also interesting, but 29k, just $1,000 away from 30k resistance and not at any of the support levels. I just find it really hard to take an interest in this market from a medium time frame perspective when it's here. But if you want to get into the granular stuff, I would just say this is the trading range that we're in. This low and this high, so 28.8 to 29.8, I mean, it's $1,000 range in Bitcoin, absolutely miserable, and you can start to add a midpoint to that if you so wish. But even on the 4 hour, it just becomes painfully clear what's going on. We essentially traded within this consolidation, then we broke down from it, and now we're trading within a new consolidation. And even the consolidation itself isn't being particularly charitable either, because you had a failed breakout to one side, and you had a failed breakout to the other side as well, and now it's just sort of chopping around the range low. Not very good conditions. I've seen some commentary on Twitter suggesting that PvP type of things don't exist. And while that's true in a sort of purist sense, where all markets are PvP, all markets are zero sum, I do think one must meaningfully differentiate between regimes. And if you can't mark out the difference between a high volatility net inflow type of regime versus what we have now, then I mean, it becomes very hard to navigate the different crypto cycles. This is sort of designed to take your money. Not that there's any explicit sort of creator of this thing, but in general, low volatility, low volume market conditions will just eat you up in trading fees, and you ought to be very, very selective as to where you do business and the timeframes of those trades. And so that's essentially BTC. Let's see what happens. And I haven't got anything else to add to that, really. Nothing terribly interesting at the moment. Maybe if the weekly starts to shape up, there might be something there, okay? Sort of above 29.2. On the daily, it would still have the same obstacle we discussed of above 29.9, probably be clearer. So this area is quite messy. If it drops lower, then we can at least start having interesting discussions about whether the pre-breakdown range at 26.7 to 28 is going to act as support. Which boundary of it and how much panic selling are we going to get from the ETF candle crowd? All of that is interesting. This at the moment is much less so. I mean, sorry, I wish, frankly, I wish it were a different market as well, but it is not. ETH has been drifting, 3 red weeks in a row for the time being. Again, you want to call this chop, but it's just going down on the weekly. It's almost reached the most generous weekly support I can think of, which is 1800. Hasn't quite done it yet. Currently spiked previous week's low, but hasn't touched that weekly. Bigger picture, the market still, as you're all painfully aware, 1935 resistance, and it's just been kind of going down since then. And the better levels aren't sort of the zoomed in version of the range low here. They become significantly discounted depending on how you draw your range. If you take the recent range of sort of 1900 to 1400, you get 1600, which is a nice weekly level. If you take the bigger range between 1900 and 1000, you get a midpoint of 1500. Those are both levels that are at least somewhat clearer. Whereas up here, my biggest issue with the market as a whole is that it looks like 30k and 2k are acting as resistance, but the market is just too close to them in order for me to look for supports that are meaningful. So I can't, as I've sort of tried to explain before, it's very hard to hold at the same time that 30k is strong resistance, but then to argue that 29k is a worthwhile support. Because if it's strong resistance, it should nuke the market a lot lower than it is now. Whereas if it's not strong resistance, then the market should be able to break it and provide a reclaim play. That's why those two scenarios are painfully clear to me, because they will essentially solve the puzzle as to whether 30k is strong resistance or not. If it is, buying 29k is insanity. If it's not, then buying above 30k seems like a better trade. But this kind of diddling in the middle where it might be strong resistance, I'm going to buy $1,000 lower, it just sort of neither here nor there. And that's my greatest problem with this. Similar with ETH, right? It's like, is 1900 strong resistance? It looks like it. Well, if that's true, then buying 1800 is unlikely to work out. Whereas if it's not strong resistance and 1800 actually works out, then you can still catch the continuation trade through 1900 without worrying about these 3-4 weeks of chop P&L bleed. Hopefully the argument makes sense, at least it makes sense in my head, and that tends to be good enough for me. People are asking about legacy and S&P stuff as well. I don't have super strong views here. I sort of tweeted out a chart which had these monthly levels at 1450 and the underside of this candle. I mean, it looks okay for now. Obviously, this month is red, but nothing terribly decisive yet. And I was very generous in marking these out, because normally what I would do, as I've done in the past, is take the highest close here. And if you take that lens, and it very much could well be the case, what a mouthful, that the monthly time frame gets saved. So that's not too scary yet. The monthly hasn't made a decision. The weekly is all right. I mean, I had this not engulfing candle, but at least some sort of red impulsive candle, bigger than we've seen before, at a contextual level of resistance. So yeah, that's sort of not great. And the daily is the most interesting time frame for me at the moment, because it will be retesting an area of market structure at 4,500 or thereabouts. If you observe the nature of this uptrend that crypto hasn't enjoyed since the start of the year, I mean, that's not entirely fair, but relative to the S&P, the performance has been underwhelming in terms of how much of the bear market was retraced, essentially. Once we got through this messy area at 4,000, the market didn't sort of violate daily time frame market structure the entire way up until recently, where it actually made a lower low on the daily time frame for the first time. So either this is just like a deviation that ends up being a fake out nothing burger, or this is the first low time frame shift in market structure before the other time frames essentially align and push it down lower. My inclination is that this market structure shift is meaningful, and that the second half of the year might be a bit trickier, because the sort of 4,600 really feels like an apex type of price, especially going into the summer lull. But I don't have strong views on this. And the reason I don't have strong views on this is because the S&P hasn't been of much help to us, at least when it comes to the upside, which makes it slightly more concerning. So if we take the picture that the S&P is roughly somewhat in a hand wavy area of resistance, that could spill over to crypto if it gets volatile enough. However, even if I were to make bullish S&P arguments, the correlation has been such that we've enjoyed none of the upside of the S&P going up and all of the downside of the S&P going down. So until that relationship changes, that's, I think, a much more fundamentally important risk barometer than whether the S&P is going to go up or down 10, 50 handles or whatever it may be. But that's kind of the broad commentary there. In and around the high time frame area of resistance, with some, the first red flag, if you will, on the daily time frame with this break of market structure. So at the very least, it's not helping. And it's not helping a market that's been very anemic recently. That's really all I've got to say. I think I got tied up on another matter. Before that, I wanted to add some commentary about sort of low time frame futures data, as I saw this open interest ramp up on the back of pretty aggressive selling, both in spot and in perps. There was also a very interesting sort of divergence happening in the ETH CVD, where the futures, I believe this is futures. Yes, futures made a lower low in CVD, while spot made a higher low, and price also made a higher low. So that was an interesting divergence. If you guys want to see a bit more ad hoc order flow-esque futures data commentary and stuff like that, please let me know in the comments or leave a like on this video. Maybe if the market gets really boring, we can do just like a live session here discussing what's going on and maybe some educational content as to how to incorporate these tools. I mean, this channel is for you, so when the market's really boring, we're going to do our best to try to come up with fun, creative, educational things to help you. So if you want to see that, let me know. If it sounds terrible, also let me know. But I'm going to stop wasting your time now. Thank you to Woo for supporting the show. It's probably the most direct way to support us, so check them out if you're from a non-restricted jurisdiction and you want to spread some of your exchange counterparty risk. As always, don't keep more money on the exchange than you absolutely need to trade. So that's all from me. Enough rambling. Hope you all have a wonderful start to the week. And let's pray to the volatility gods for something better for next Monday. Thank you and goodbye.